Welcome to the 2024 Economic Preparation Channel. I'm your host, Tony. Thank you for joining me on this Tuesday, February 13th edition. Today, we're going to talk about briefly the economy added some jobs in January, but that doesn't mean that we're out of the woods yet. And we're also going to be talking about the Federal Reserve meetings and what that could possibly mean if there's no rate cuts this year. So the U.S. economy added 353,000 jobs in January, according to a CNBC.com report. That's much better than expected. But the unemployment rate, here's the concerning part, it held steady at 3.7% against the estimate for 3.8%. So unemployment rate, according to the official numbers anyway, is holding steady, even though we know that more job cuts are coming in the tech sector and other sectors as well. Average earnings only increased 0.6%, so they remain flat, but that's double the monthly estimate. And on a year-to-year basis, wages jumped 4.5%, well above the 4.1% forecast. So job growth was led by professional and business services with 74,000, along with healthcare and retail trade, as that continued to add to job growth. So this is a surprise for many economists, senior economists and analysts on CNBC and MSNBC and Fox Business and Yahoo Business Finance. This is a surprise to many people, including myself, that the job numbers are so strong. But you have to remember, folks, ladies and gentlemen, that the job growth is strong because a lot of people are returning to work, are working 2 or 3 side jobs as well, and that's counted into the part-time jobs and those who are turning from furlough or some type of other situation. That's counted within those job gains. And also remember, we had that labor union strike. Remember, we had the car union, the auto worker strike, and how that the United Auto Worker strike and how that was resolved about 2 or 3 months ago. Well, those numbers, those people returning to work, that's also included in this number here. There's 353,000 jobs that were added, quote unquote. So the numbers have been booked. You knew that, I know that, but this is what's adding in there. Now, the good news, there's still good news. I'm not a doom and gloom person. The good news is we're still adding jobs to a U.S. economy in this 15, 16, 20, $20 trillion U.S. economy. We're still adding jobs. It's just that the jobs that we're adding is meager, and the wages, even though it appears it's increasing, it's not increasing fast enough to keep up with inflation that we know is at 10 or 11%, not the 3 or 4% that we've been quoted on in the mainstream media and in other media as well. So the telltale sign is that stocks right now were mixed following the report. Dow Jones and everything is still mixed going into this February month. It went up 300 points, shot up 400 points when Fed Chair Jerome Powell came out and said that, hey, we're thinking about, cutting, but he didn't come out and say that he was going to cut rates, even though they can't service the U.S. debt load at $34 trillion debt load with high interest rates. But apparently, Federal Chair Jerome Powell, according to the AP News report, saying that he's saying that rate cuts are not imminent. Listen, we still need time to hold off and see the data. He says here, he told people that listen, we can understand that. So we know what happens if they don't cut the rates in May or June. Most economists expect the first rate cut to occur in May or June. Okay, what if the rate cuts don't come in May or June? If they don't come, you know what that means, ladies and gentlemen. That means more layoffs and more reorganizations, restructuring of funds by these companies, private companies and stuff like that. That's what's going to happen if they don't get the rate cut in May or June. Now, if they do cut the rates, if they do cut the rates in May or June, it'll be a small cut, like a 0.25% basis cut, if that. Okay, so now Powell also said he wasn't ready to declare that the Fed has pulled off an elusive, quote, soft landing. He was smart enough to know that. We know that the soft landing is not there. This is controlling inflation without causing recession. So it's possible that this year or next year, beginning of next year, could be the severe recession that everybody's been waiting on. Not waiting on, but everybody's been anticipating or saying that, the numbers are not adding up here. How can we have a strong economy but more people are, 75% of Americans are living paycheck to paycheck, even if they make $100K or more. And everything is going up, and supplies are starting to come. Crisis is going down too. So mortgage rates too is another thing to watch too. The Fed cuts, whenever they come, won't automatically lower mortgage rates, but they should over time. Mortgage rates in the 1980s, and back then was like 10 or 12%. That was normal. Nowadays it's like 7 or 8%. And some people before the pandemic, of course, got that sub 3% rate. But that's going to be falling. That's going to be coming shortly. Mortgage rates will continue to rise over time. I don't see it going back to a 3% or 2% thing, 0% like they had in the past at the beginning of this health crisis or pandemic. So we can kiss that goodbye. Just using base net. But once again, I'm not going to say never say never, because all of the fundamentals that the economists and everybody all the experts have been saying has been wrong time and time again, because we're not in a fundamental type of economy. We're not in that type of economy when you can print up money at the drop of a dime, and that money loses value over time, which it has already done, as you know. So investors are hoping for a rate cut in March, at the end of March, but that is going to be dashed because Fed Chair Jerome Powell basically stomped out speculation that Fed will cut rates in March, as I said before, and so that leaves only a May or June type of thing for a cut, and so that's going to be very, very dicey, because by then we could have more layoffs, we can have higher prices. Inflation, they can't cook the books to see inflation, because the American people will automatically see that inflation is way higher than the 3 or 4% they've been quoting on, and this is just not in the CPI goods, but in all the goods across the board, from construction to manufacturing to groceries to gas to rent. Everything is going to be high, and it's going to continue to be high. So look out for that. Look out for those things coming up in the spring and the summer. But right now we're still in the winter period, and this means that they're going to kind of hold everything steady, and they're really looking to see if the employment numbers remain steady going through the second quarter of 2024. So God bless. Continue to prepare. I'll talk to you very soon, guys.